Hello, folks. Welcome to School of Business Learning. Today, we're gonna discuss an important uh, concept that is capital structure and theories related to capital structure. First of all, we need to define what is capital structure. Capital structure refers to the amount of debt or equity employed by a firm to fund its operation and finance its assets. A firm capital structure typically expressed as debt to equity. So, the amount of debt and the amount of equity comprises of capital structure. Capital structure can vary from industry to industry. Capital structure uh, can vary from, let's say, if we take the example of mining industry, there is a different capital structure. If we take example of chemical industries, it's different. Like banking industries, insurance industries, the capital structure can vary. The private companies have harder time using capital structure over equity, particularly the small business, which are required for personal guarantees for their owners. So the capital structure varies. There are few pros and cons of equity as well as of debt because capital structure comprises of these two elements. First of all, we will talk about the equity part. In equity part, there are no interest payment. You don't have to pay any sort of interest. There is no fixed payments as well. The dividend is at your discretion, at the discretion of board of directors. There is no maturity dates. Ownership and control over the business. The equity holders are always in the control of their business, always owns the company. The equity holders have a voting right through which they can elect their board of directors. But the cost of equity is always higher. And the equity holders always expect a high rate of return. And the equity holder, another disadvantage of equity is they have a last claim in firm assets in event of liquidation, but they can provide maximum operational flexibility. Now, coming on to the debt side, what are the pros and cons of the debt? Debt has interest payments typically, a fixed repayment schedule as well. You have to pay according to the terms and condition that was agreed by the financier. The debt holder has a first claim on the business assets in event of liquidation. This is one big advantage for debt holders. Otherwise, it's very difficult. Debt holders have company when dealing with the debt have very much restrictions on operational flexibility because they have to pay the interest. The interest schedule is fixed. But one advantage is the debt is always lower than the equity. This is one big, the cost of debt is lower than the equity. And if the cost of debt is lower, the expected rate of return is lower than the equity as well. But now the question arises, as we discussed, the capital structure varies from industry to industry. There are few advantages of equity, few advantages of debt as well. But question arises, what is the optimal capital structure? What is that structure that suits to any company? The optimal capital structure of the firm is often defined as the portion of debt and equity that results in lower weighted average cost of capital. So it is a debt cost where your capital structure or the cost is lower. This technical definition is not always used in practice. And the firm often have a strategic or philosophical view of what the ideal capital structure should be. So the straightforward answer is a 10%, 20%, 40%. There is no as such answer. You have to see or consider number of other factors. Sometime if you include debt, your company is called highly levered company. And when the portion of debt is low, your company is at the low leverage or the low levered. So what is the ideal mix? It varies a lot. Now coming on to cost of capital versus cost of debt. The cost of equity is, as we discussed, is higher than the cost of debt. Equity investors are compensated more generously because equity is riskier than the debt. Debt holders are paid before the equity investors. Debt holders are guaranteed payments, while equity investors are not. Debt holders is often secured by the specific asset, while the equity holder is not. In exchange for risk less taking risk less, debt holders have a low expected rate of return. In the next video, we will discuss about the theories of capital structure. If you have any question, you can drop into the comment box. Do share and like and subscribe this video. Thank you so much.